I'm going to give everybody a little bit of context about my background, and then we'll go straight into the content. I've worked in financial services for over 20 years now. I started my career in Barclays Bank in the UK, which is a big traditional bank. I spent some time consulting for Deloitte, and then in the last sort of maybe 7 or 8 years, I've worked in the fintech and challenger banking space. I was part of the team that launched one of the first digital banks in the UK. And then since then, I've helped launch a number of different businesses. So a blockchain-based trade finance bank, an SME-focused neobank, insurtech businesses, remittance businesses, and now D360. There's something really exciting about digital banking. And really, I hope that I can share some of that sort of knowledge and understanding with you today. But really, the thing that I really want to get across is that digital banking allows us to start to think about banking as a service industry again. It allows us to think about how we bring products and services to customers, how we do the right thing for customers, and how we put the customers in control of their financial lives. So I'm going to take you through a bit of a sort of background context around what digital banking is, how we've got to digital banking, and then what some of the opportunities and challenges are. Please ask questions as we go through. The team will try and answer them, or we might have time to answer some towards the end. Okay. So I'm going to start with a bit of an understanding of what actually is digital banking. What do we mean when we talk about digital banking? And the simplest way to think about it really is that everything that people have done in traditional bricks and mortar banks, we put in a digital form for people. So we take things like onboarding. You can do that as a straight through digital journey. You don't need to go to a branch with a lot of paperwork and documentation. We can do payments. We can send money to anywhere, your friends next door, people around the world, and you can do that from a digital device. You don't need to go to a branch to do it. You can pay bills, you can open accounts. As we get more sophisticated, we can do instant approval and disbursement of loans. So you can apply for credit, you can get a decision instantly, and you can have the money in your bank account within hours rather than within days or weeks as it has been traditionally. The really important thing about that is that it means that you're constantly informed about your banking, you're constantly in control of your banking, and overall that means hopefully that the financial health of the people that are using digital banks grows. And what I mean by financial health is your own understanding of your positions, your ability to pay on time, your ability to borrow well and to repay well. Beyond what you see, so you've probably all got mobile banking apps from your existing banks, you've probably got variations of online banking that you've used. Beyond what you can see, that there's a really big difference between a digital bank and where some of our traditional banks have come from. And with a digital bank, we really think about how we digitize every single bit of our operating model. It's not just about what you can see on your device, it's about everything that we do in the background as well. So we try and make sure that every single customer journey is completed straight through. We try and make sure that we're using digital journeys within our service channels, our service teams, to make sure that our service teams understand you, they understand where you're up to, they can help you straight away. As I say, we try and use it to make our decisions, so our risk-based decisions, to lend instantly, to do it in an automated way, maybe even pre-approval of credit, so we can tell you up front what we can lend to you, so you can have that credit immediately. And we also try and make all of our back office processes, so our HR processes, our finance processes, our procurement processes, we try and do that using digital technology as well. This does a number of things, right? So it means that products and services are available to you more quickly, more instantly, more rapidly, but it also means that we can reduce the cost associated with providing those services to customers, which in turn we hope we can pass on as value to our customers, so we can give better pricing, we can give better access. One of the big differences between digital banks, traditional banks, new digital banks and old digital banks is that we've changed how we think about digital. So when I started building Tandem, which was one of the first digital banks in the UK, we really thought it was really critical that you had a digital capability that was generally led outside of the technology function. What we've really learned is that isn't actually enough. right? So if we're going to be a digital bank, if we're going to structure everything that we do in a digital way, if we're going to best understand how to leverage digital technology, we have to go beyond the technology team and our digital talent, our digital capabilities. We have to make sure that every function, the risk function, the compliance function, the HR function, think about how digital technology can deliver their services and their products. And what that means, it really is, in a digital bank, digital is part of every single person in the bank's job. It's not just something that happens with technology and is delivered to underpin the rest of the functions. It's really, really part of everybody's role. Innovation is part of everybody's role, and considering how we deliver digital is a critical part of everybody's role. If we think about where digital banks have come from, it's actually really useful to think back to how banking has worked, right? And the reason I say that is that technology and banking has only really been around for the last 60 years. As much as most of us on the call, I'm sure, have only ever really experienced banks with some sort of online banking or mobile banking capability, it's only 60 years old. When we built the early technology, we were quite constrained by that technology and limited in what that technology could do. And that meant that we often put constraints on the products and services that we built. So when we think about digitizing those products and services and using new technology now, we sometimes forget what the original use cases were for banking. But we can go back thousands of years to think about that, right? We can go back to the ancient empires of Egypt, of Babylon, of Assyria, where people started to use things like standard sizes of weights, standard sizes of gold rings to be a medium of exchange that could be exchanged for goods. So it could be used to buy grain, it could be used to buy fabrics, materials, whatever it was that people had, but people started to use these standard mediums of exchange, early currencies, to purchase these things. As we started to use money as a medium of exchange, we also started to understand that we didn't always want to carry all of that around. Sometimes we needed to store it somewhere, and sometimes the way that we stored that wasn't easy to transfer. So we started to get, via community structures, verbal law dependent on the community, and we started to see a record of stored value. We started to see a written form of creating essentially what's an early ledger, so that we can see who owns what money, how it is owned. And the picture that I put here, where we talk about a record of value and transfer, is something called a Yap stone. Some of you may have come across Yap, a kind of fintech in the region. But what the Yap stone really represents is a very, very early form of currency where people understood that a particular stone belonged to a particular person, that a particular size of stone had a particular value, and people could pass on that stone, that value, to somebody without physically moving the stone, without physically switching the location of the stone. So it really started to become an abstracted ledger concept as well. If we go to the Middle Ages, we went beyond needing to exchange money for goods and services to global trade routes, right? So shipping through Europe. We had boats, big merchants coming in with their boats, where they either needed to finance the shipment before it went out, or they needed to deposit large sums of cash in a particular way when it came back. So we started to get the concept of lending, merchant lending, ledgers associated with that, and also the concept of foreign currency. So different merchants in different markets had different currencies. They often tried to compete with each other to devalue those currencies. And from that, we also started to bring in the earliest forms of regulation and central banking and foreign currency management. As we went into the Industrial Revolution, so the late 18th, 19th century, our demands in terms of industry significantly changed. We needed to build factories, we needed to buy goods, and we needed to manufacture from those goods. And as we did all of that, again, we started to iterate what our demands for products became. So we needed to have things like mortgages, we needed to have things like investments, we needed to have bigger loans secured against different asset classes. So we really started to see the emergence of modern banking products as we know them. And then we kind of come to the late 19th century when we introduced the ability to send telegrams, and that allowed us to now have conversations with countries in different places, send electronic messages, so that we essentially could start to transfer currency that way. As I said before, it wasn't until the 1960s that we really started to see the technology that we recognise today in banking. So the world's first ATM was launched in 1967. Right, that's actually quite recent history. It was launched in London. It was actually a Barclays bank machine in London. And with the ATM, what we started to see was things like debit cards. So I didn't need to have the ancient medium of exchange, the currency, in my pocket anymore. I suddenly had access to cards that would allow me to pay for things. We started to see the birth of consumerism, of e-commerce, and all of the transactions as we know them today. And as I say, it's really useful to start to think back to why those things exist, why people need those things, rather than just thinking about our technology. So, you know, if we're looking at replacing outdated technology, are the new ways that we can store and exchange value? Are the more efficient and reliable ways to record that value and that transfer of value? Can we make products available more readily, more efficiently at the time when customers need them? Can we lend to new business models or underserved communities? What technologies help us solve old and new customer challenges differently? As I say, what traditional banks, if I look back to some of the big banks, banks often look at how I recreate the technology that I've deployed in my banking system. What Challenge is doing is looking to these questions to understand how consumers use money, how consumers use financial products, and looking at ways that we can deliver them differently. Essentially, we're trying to do banking better, not just replace technology, and do banking technically better. So what's the impact of all of that? What does that mean for customers who are using our banks? Ultimately, digital banking has an opportunity to drive not just the banking landscape, but also how customers access banking services, and how banking drives economic growth and contributes to economic growth, the financial health of SMEs and consumers. Digital banking, fintech, it's creating jobs, it's driving economic participation, it's attracting foreign investment, and it facilitates an SME economy in a different way. Now, the way it's doing that is it's providing convenience to consumers. So customers can access their banking anytime, any place, wherever they want to. They don't have to wait until the branch is open or there's somebody at the end of a phone to answer the phone. They don't have to travel to get served. The bank is basically in their pocket. And what that means is the consumers have a better understanding of their financial health. They can respond to that more quickly. Which sometimes means that we need to provide different products, simpler products, smaller products for people, but it means that people can stay on top of that, and that means that individuals can contribute more to the economy. We find with digital banking, we can drive inclusion in the banking market. And what I mean by that is that we have a huge global population of people that don't have access to banking services. And that can be anything from they just don't have a bank account, they don't have payment mechanisms, or it could mean they don't have access to lending and to credit. What digital banking means is that because we typically have a lower cost to serve our customers, and we typically have enhanced credit decisioning models, different ways of looking at credit and affording credit, we can actually start to include different people in the financial ecosystem. So we can bank people that haven't previously been banked. We can lend to people that have struggled to have access to credit historically. If we look at sort of the last 10 years of fintech, we can see something like 1.2 billion people globally now have access to banking as a result of digital banking and fintech that didn't have before. That's a huge number, 1.2 billion people. Again, if we think about the financial impact of banking those people, of bringing those people into financial systems, of increasing their financial health, their access to credit, their access to growth, we can see that we're contributing to the economy. We have efficiency in digital banking. We can send money more quickly. We can send it more cheaply. What that means is that we can do it with reduced fees. It's really important when we think about remittances. So we have a huge expatriate population, people remitting money to various places. What we found with digital banking and fintech is we can do that at 50% of the cost to the end consumer than we could do before. If we look at the value of every single dollar that's remitted, the value of that dollar is significantly more than an aid dollar or a government investment dollar in the markets that it goes to. So those remittances directly help economies around the world. They directly help families around the world. And digital banking is making that impact even greater, which is brilliant. And then the other thing I'm going to touch on very, very briefly is the concept of democratization. So the other thing that digital banking is allowing us to do is to make products and services available to end customers who perhaps didn't have access to those products and services before. Often we kept those as banks or venture capital firms. So we start to see things like peer-to-peer lending solutions. So I potentially could deposit my funds, invest my funds, and those funds could be used to lend to an SME, but it's me rather than a bank making that lending. We start to see things like crowdfunding. So small businesses can raise money in exchange for equity. So essentially we're starting to bring things like venture capital to consumer markets. We have brokerage platforms that means people can buy and trade in equities, in funds directly themselves from their phone straight away, instantly, at a very low cost, where before it was prohibited. So digital banking has also increased the kind of sophistication of products that we can make available to people and the ease with which we can make them available. What we find is that the most sort of successful digital banking and fintech markets have a number of common themes to them. So those kind of common themes are around having a friendly regulator, a regulator who is making progressive regulatory decisions, introducing new regulations to facilitate new technology. We have a large digitally skewed customer base that we can bring into the digital banking ecosystem. We have a talent pool of people to build and develop digital banking capabilities, fintech capabilities, and we have access to investment. So we have people who are prepared to fund those investments. If we look at what's happening in Saudi today, some of these characteristics are just inherent in the market, right? So we've got quite a low per capita bank concentration. So that means there is a consumer base that digital banks can serve. We've got an underserved SME community in terms of the lending and credit that's made available to SMEs. We've got a mobile first population. So I think something ridiculous like 94% of the population have a smartphone. I've seen statistics previously that say things like people have on average 2.4 phones in the kingdom, which I can't cope with one, so it find staggering. And also we have a really well developed education system, tertiary education system, that starts to build some of the talent. Other enablers have or are being developed. So we've seen new regulations for digital banking and payment companies. We've seen sandboxes to test the kind of different potential fintechs that might come. We're seeing people connect the dots between investment and digital banking and kind of fintech startup. And we're also seeing people try and create more and more talent capability beyond the education structures that are there. So, you know, the session that we're having today, the ongoing investment of organizations like Fintech Saudi is creating that ecosystem for digital banking and fintech to be successful. What we've seen is that in the kingdom, as a result of all of these investments, we have a huge growth in the number of fintechs that are launching, but also we've had some really good success in digital banking. So, you know, Saudi Arabia was the first market in the Middle East to launch a combined digital and physical banking proposition with Mean, that was launched by GIB in 2014. We've got the new regulations for digital banking licenses, which mean that we have 3 banks like D360 who are getting really close to being able to launch their services and provide really full digital banking services in the kingdom. We also have the traditional banks here who are making leaps and bounds in terms of delivering their own digital apps to consumers, mobile apps to consumers. And really, I think what we're seeing is that Saudi Arabia is absolutely accelerating in the Middle East to be a leader in digital banking capability, because it has access to all of these things that maybe some of the other markets don't. And we're starting to see an acceleration compared to global players as well. So if we go back to 2021, we saw for the first time that digital payments, cashless payments, overtook physical cash payments. Some of it triggered by the pandemic. The pandemic has definitely accelerated some of that digitization, but we're seeing increasingly the adoption, the propensity, the desire for digital banks, digital services, and digital payment mechanisms. I've said a lot of positive things about digital banking, right? It's not all easy, and it's not all positive all of the time. So we have challenges, we have things we have to think about, and we have to plan for. When I first started my career at Barclays, we didn't have we had an online bank, but it was a very small online bank. We had big heavy counters in branches that dealt with a lot of cash, a lot of checks, a lot of physical transactions. And we were really worried about things like people turning up in branches with guns to take all of our money away from us. It was something that happened far too often in the UK. We've always seen operational risk in banks. We've always taken measures to manage that operational risk. But where things like the people robbing branches have gone with digital banking, we haven't got branches to be robbed. Where things like people coming into branches with false documents have gone, we don't have to worry about that anymore. We do have a completely different set of those operational risks and those operational losses, which comes into the cybersecurity space. So we do see some identity theft. We do see some social engineering, phishing attacks and things like that we have to be mindful of. And it's really important for any digital bank to be on top of that. It's actually also really important for all of the digital banks to work together, to share knowledge, insight, to be a step ahead, and really for the security and risk teams to be at the front of thinking of developing strategies, not just a response at the back to manage those. I said at the beginning, one of the things that's a massive advantage of digital banks is the ability to do straight through online account opening for your current account, relationship with the bank, but also for things like lending products. Unfortunately, because we've done that, we've also made it really easy for customers to open bank accounts with every digital bank, right? So we see competition. It's much harder where people traditionally had one bank account that they kept from cradle to grave. We're now seeing that people might have multiple bank accounts with different banks, and they'll switch much more quickly, much more readily. So really, we have to think about how we acquire customers and how we keep those customers with us by delighting them with our services, our products, and our engagement with them. Whilst digital banks have been really good at acquiring customer numbers over kind of a 5-ish year window, they've really struggled to transition from being payment type providers to being full bank relationships. They've really struggled to achieve profitability. So we'll touch on this in a minute, but it's really hard for digital banks. If you look at a traditional bank, they have big balance sheets, they have lending, they have savings, they have transacting. It takes time to build up that portfolio. So digital banks don't jump to profitability quickly. And then the final point here is that the day that we launch our bank, the day we launch our products and services, we become legacy, right? Everything that we have is already there. It's harder to change, it's harder to build, it's difficult to think about and innovate. So it's really important that both in our architecture, technology architecture, but also in our ways of working, we maintain agility. We maintain ways of introducing new products, new services quickly and at pace. And one thing that you do see with digital banks compared to traditional banks, if you look at the data, is they're probably launching 10 times as many features in a period as a traditional bank, so that they're really having to keep up with that continual development. Very quickly, I've got some numbers on here around acquisition. This is UK data, so it's not necessarily relevant to us directly, but we can definitely learn a lot from it if we look at it. And if we look at the market share of current accounts in purple on the left-hand side and business accounts in blue on the right-hand side in the UK, what we see is that the traditional banks have still dominated market share. So if we look over the kind of like last 4 years, even though challenger banks have been around for 10 years now in the UK, their market share hasn't accelerated that quickly early on. So the first digital banks launched in 2015-ish, 2014, 15. 4 years in, 5 years in, they still only had 1% market share in the market. What we have seen then is once they've kind of developed more services, they've added more layers, that market share has grown. We've actually seen quite rapid adoption of it in the last year, but I think it's really important to know that that growth of market share for a digital bank takes time. We have to build trust, we have to build a breadth of products and services, we have to try some things out and learn that maybe they don't quite work, and we have to iterate them. But the digital challenger banks really have to test their services, try different things, be patient in acquisition, earn loyalty and trust from the consumer base, and make sure that we're going on a journey with the customers we're asking to adopt us. And I talked a little bit about profitability. So only 20 out of 453 global challenger banks were profitable in 2022. Right, that's a very, very small percentage of the total number of challenger banks. You can kind of see here that the average timeline to profitability is 5 years and 6 months. We see a company like Bonk that's taken 10 years to get there. We see other companies that have maybe learned from that experience and taken a little bit less time, and definitely it's reducing over time. The reason that banks have struggled to be profitable is that once we've invested in building all of our technology, we still have to keep investing. We have to invest in acquiring customers. We often find that even though we acquire those customers, we get a lot of customers who are willing to try digital banking out, but not necessarily to make it their primary bank account. So we end up with quite a degree of dormancy, accounts that aren't being used. We tend to have lower deposit rates, at least to start off with, than traditional banks. And again, that's about building the consumer trust. But often new banks have 10% of deposit value per customer that a traditional bank would be. So we've got a long way to go to build that up. And also because we don't have that base of current account customers at the beginning, it's quite hard to sell loans and savings products, slightly stickier products to people. That said, there are lessons we can learn. So if we look at the kind of 20 banks that have become profitable, they have some common themes. So the first one is that they have diversified their revenue streams, and they've moved into markets that have a broader opportunity. So that you see a real kind of theme of SME banking across a lot of these providers. The reason that SME is really attractive in here is that SME typically has been underserved even in online banking and mobile banking provided by traditional banks. They tend to get a bit trapped between retail and corporate offerings, and people don't necessarily think about building the e-commerce tools, the financial management, the invoicing, the petty cash solutions, expense management solutions, access to credit for SMEs. So a lot of the profitable banks have focused on building these solutions and deploying those solutions differentiated, valuable, attractive to businesses. Lending is a really profitable part of any bank, and a lot of the digital banks today start with payment suppliers, and it's taken them time to transition into being able to lend. So to acquire the customers, to build the credit models, to test the credit models, and allow them to make those decisions. We've got focus on cost, right? So digital banks have to make sure that they are bringing in a real cost advantaged play. Beyond the initial acquisition, we have to make sure that we're taking operational efficiency into the business model, and that we're working it out from that perspective. And we have to be data driven. So we have to deliver exceptional customer service, but we have to understand, using our data, which customers are most valuable to us and how we can maximize the relationship with those individual customers. If we look to the future, there are quite a lot of opportunities for digital banks to think about how they can go beyond providing the basic products and services that we might see when digital banks increase in the kingdom. So the first thing is looking at how we can partner with other providers to bring in solutions more quickly. So we've said it's quite hard, for example, for a digital bank to transition from payments to doing lending itself. It's absolutely possible for a digital bank to partner with somebody to bring products like lending, peer-to-peer to the market more quickly. What that tends to give us is it tends to give us more products that we can deliver to customers. It tends to allow us to bring those products to market more quickly. And it tends to allow us to increase the value and volume of our lending and deposit base. It gives us more access to share of payments, revenue, and it means we can deliver things more quickly. The next thing that we can talk about is embedded solutions. So many of you, I'm sure, will have bought something at point of sale and been able to repay that back over a number of payments. What we're finding, and this goes back again, if we think about when merchants started to lend against a trade ship, what they were doing was they were going down to the dock and they were meeting the ship owner and they were looking at the cargo and they were making a decision there and then to lend to that person. With technology, what we did is we centralized all of that into banking halls and big technology systems. What embedded solutions are doing is putting that back into the customer journey at the point at which they need it. So customers typically don't go and buy a credit card. They don't go and buy a remittance. They don't go and buy insurance or a loan or a mortgage. They buy clothes. They buy a house, they buy a car, they travel. And so what we're seeing is the embedded payments, insurance, finance is increasingly more relevant to the consumer. It's increasingly at the moment that they need it. We think that you're going to start to see that across accounts. We're going to see it across payments. We're going to continue to see it across lending and card provision. But really interestingly, the kind of embedded finance model today is probably globally worth around 55 billion euros. People are starting to now predict that over the next 4 or 5 years, that's going to triple in size and scale. And beyond that, it will continue. So being able to embed our solutions in customer journeys is going to be critical. And finally, if we think about both of those things, open banking, I know there's a session in a couple of weeks on open banking. Open banking for us is a critical enabler of most of what we can do. So having clear open banking standards that everybody in the market can use and can follow are really a big enabler of us being able to bring more products and services to markets and to our customers and consumers. The thing about everything that I've just talked about here is that most of those things, so embedded finance, partnerships, open banking, it's all going to be hygiene in banking in the next 3 to 5 years. If we look at the pace of adoption, if we look at the pace of change. So we also have to start to think about what comes after those 3 to 5 years. What are the emerging markets that are going to come next? And what are the demands of banks, financial services institutions of those markets? So if we think about things like the metaverse, what is the currency of the metaverse? How does banking serve the metaverse? If we think about space, right, we're not that far now from space tourism. We're not that far from space habitation that comes with space tourism. There isn't a governance model, there isn't a legal model, there isn't a regulatory framework in areas like space. Our existing currencies that we replace coins with, so our debit cards, our credit cards, our wallets on our phones, don't naturally necessarily work there. We need to start to think about how we might leverage some of the newer technologies, so things like cryptocurrency, things like blockchain technology, to start to be able to look at how we can extrapolate banking services to new frontiers, new markets. And also, again, I go back to the point in partnerships here. When we are a digital bank, when we've launched as a new challenger bank, we are part of the legacy. We are part of the fabric of the market. We have to prioritize where we invest our money, where we develop our money. So as we look at some of those emerging spaces and some of those emerging markets, the ability to make really good partnership models, the ability to do that technically and commercially will be critical for us to be successful. And that is everything I have to take you through today. So thank you for your time. I haven't been following the Q&A as we've been going because I've been talking to you and I can't multitask as much as I should. So I hope that you found some of it useful. And I'm sure if there are any questions, they'll be passed over to me now.
No, thank you very much, Sarah. That was awesome. Digital banking is one of my favorite topics, and you covered it on point in terms of the talking about the history and the impact and where we're looking to the future. So thank you very much for your presentation. As ever, we do have a lot of questions coming through, so I'm just going to sort of try and group them a little bit and see where we work. And Manira, you can help me with this as well. But let's just start with definitions, right? So we got asked questions about what actually makes a digital bank as opposed to a traditional bank, which has a digital component to it, as opposed to a fintech company. So if you could just sort of run how digital banking is different from those two categories in particular.
Yeah, sure. Let's start with traditional banks, right? So a digital bank compared to a traditional bank, we don't have branches. So a digital bank really is only available to you via digital channels. Is this a challenge or an opportunity? For me, it's an opportunity because very few people today actually go to those branches, those physical stores, and those physical stores in turn become quite a big overhead. They carry a degree of operational risk. So we provide all of the products and services digitally. We often back it up with some sort of support. So there's often a call center, there's often human chat available to support that. But the really important thing is, again, that if I go and look at, I bank with HSBC in the UAE, and if I look at their mobile app, they have a limited set of functionality that I can do on the mobile app. They have maybe a slightly broader set of functionality on the website. And then there are some things that I still need to speak to a person or go and visit somebody to do. With a digital bank, you can do all of those things via your mobile, your digital product. You don't have to go and visit a branch to do something. If I think about fintech, the big difference here really comes down to regulation. So fintechs typically are not licensed as banks. We might see fintechs in two different ways. So we will see fintechs that are direct to consumer fintechs. They're providing a product or a service to an end user. We also see fintechs that are enabling fintechs that really are providing technology to banks to deliver products and services. But the big difference is that a fintech that's providing services direct to consumer will be quite limited in the range of services that it can provide. So it might provide payments capability, it might provide some lending capability, but for the most part, it won't be deposit taking, it won't have deposit protection, and it won't offer a full balance sheet of solutions.
And I think just to add to that, we do see fintechs which can graduate to become digital banks, right? So
Absolutely.
the likes of Revolut, where they start with one fintech area and then sort of layer on services.
Yeah, and I mean, there's a really clear reason for that, right? So when Revolut was starting, it was around the same time we were starting Tandem in the UK. So you had Revolut, you had Monzo, you had Tandem. We're all trying to go through this journey at the same time, and we all took slightly different paths. So if you go through the route of applying for a banking license, first of all, it's a lot of paper, right? So you have to write a lot of documents to get access to that license. But secondly, it's also a lot of capital. So not just the capital it takes to build your products and services, but the capital that you have to use to run your business, the operating capital. If you are a payment service provider, you go for a payments license first. It's a simpler license to get, it's a less expensive license to get. But what it allows you to do is to build a lot of customer base, to understand that customer base, to get data about that customer base that you can use to build things like lending models later when you choose to transition to a banking license. You have a view of success, you can raise funds in a different way. And actually, particularly if you look at the banks like Revolut, they were raising money in a VC-led way. So they wanted to raise that money as cheaply as possible, that investment. They wanted to give as little equity as possible for that investment. And in order to do that, they had to prove things very, very quickly, like customer traction, customer adoption. So it became really important for them to really think about that journey as well as the journey to balance sheet.
Great, thank you. And then let's bring this back to Saudi Arabia. So we've talked about there isn't a operating digital bank in the sense of a bank without any branches in the kingdom at the moment. We, as you mentioned, we've got the likes of Neem, which is trying a hybrid model with GIB. Even Emirates NBD have got the sort of Live app, which they've tried to do things with. So, I mean, we've got some good banks in the kingdom which have got good digital presence now, where you can do a lot of things online and mobile and web. So how would a new challenger digital bank like D360 be able to compete with something which is quite sort of which is quite stable and sustained in the marketplace?
Yeah, and again, right, so let me give some context around the evolution of digital services within traditional banks. When standalone digital banks started, the fintechs that I just referred to as service fintechs didn't necessarily exist in abundance. So we didn't necessarily have access to things like the more digital core banking capabilities, the more digital payment capabilities that existed. What we found over the period of time that digital banks have been around and have been launching is it's much more easy for traditional banks to get access to new technology, to build with that and to learn lessons around digital transformation. So we've definitely seen one of the positive benefits of digital and challenger banking be that it's encouraged legacy banks to look at their own services and look at how they provide those services and make them better. That said, a kind of legacy bank is still constrained by its operating model that maybe isn't digital. So I talked a little bit around, if we have a lower cost operating model as a digital bank, we can give you better pricing. If we have a different risk appetite, a different way of making risk decisions by looking at different data sets than perhaps traditional banks have looked at, we can lend to segments of society that perhaps haven't easily been lent to before. And I think even within Saudi Arabia, we can absolutely look to pockets of the market that maybe haven't been served as well by big banks, as other banks. SME is a classic example of that, right? We can look at how we create services in those areas that are different. And then I think the other thing is that even though banks are delivering online capabilities, they're not providing everything digitally. So there are still things that you're constrained by that all of a sudden you just can't do, you can't fix without going somewhere to physically do it. Digital banks, really that convenience, that efficiency, that opportunity to do everything in one place when you want to do it is a massive step change. The ability to understand how well you're doing, the ability to send payments quickly to your friend when you've split the bill at dinner, just by knowing their mobile number or them being part of the same bank. There are things where we're much more integrated into what I describe as a customer journey, if I'm going to give you a kind of technical term, but we're much more integrated into the things that you're doing at the time that you're doing them than some of the banks who've given a mobile banking app are. I think we can learn a lot from legacy banks on that journey to mobile banking as well, right? It's a digital bank, and we should seek to learn that. So often the things that are being delivered in mobile banks are being delivered because they're things that customers do frequently. They're things that make a difference for customers. So we can absolutely look to those journeys. We can absolutely take feedback about what's working well and what's not working well, and learn from that as well, and look to kind of deploy some of those things ourselves as well.
Thank you for that. And one of the key things which was really interesting, which you said, is going back to first principles. How were things done historically, and then building a product or service based on how things were done historically. Could you give an example of how you've looked at that, and sort of an example of something which you may create as a result of it?
Yeah, I mean, I think, again, let's look at embedded finance, right? So when we're looking at something like embedding finance in a journey, we are looking at putting ourselves in the middle of a physical situation that a consumer is going through. If I look at how banks centralized risk decisioning when they started to introduce technology, they centralized it away from the people that knew local factors, local demographics, local situations, and they made very structured decision models. If I look at data, I'm going to talk back to space again very quickly, but if I look at what something like Earth observation can tell me today, it can tell me what local weather systems are going to impact agriculture globally. It can tell me where somebody is acting sustainably, is acting in a green way. So I don't need to go to the kind of traditional banking transactional data, looking at it to do credit models. I can actually now go using technology to understand customers' local market, to understand the local conditions of that, to make a decision based on something which is more micro than is macro in its context. So really the big difference is that we're going back to personalization. We're going back to being immediately relevant. Maybe when we start to talk about a store of value, we do need to think about digital currency as a concept of a store of value. Maybe there will be situations in which that's relevant, particularly as we start to think about the increase of AI and robotics, autonomous vehicles as an example. Is there a need for autonomous machines to be able to have a currency, a mechanism of exchange, a ledger of exchange that allows them to interact, that isn't a traditional banking solution? So we really can go back to multiple situations, multiple scenarios where we bring in the concepts, store of value, ledger of value, be in the moment of the credit decision, understand the locality of that credit decision, understand the individuals involved in that decision, rather than just looking at how we replace a legacy technology view of things like cash.
So essentially going back to basics of how things work, and then applying technology where it makes sense to apply technology to make those models better for the customer.
Yeah. And that's a really interesting point. It's a really big learn about using technology in the right way. So I haven't gone deep into any of the technology elements of digital banking today, and there really is a reason for that. That for me, the technology that's available to us, we look to how it solves the customer problem. We look to how it solves the customer journey. We don't just build it because it's available, right? We have to have a really strong use case for it, a really strong understanding of why it's going to be used. And I think that's why we've seen maybe slower adoption of some newer technologies like blockchain than perhaps we anticipated a number of years ago, 4 or 5 years ago, even still quite recently. But we are seeing those things now start to find a home. We are seeing those things start to find relevant use cases that can be extended. But the important thing is we're not just using it to replace a bank's ledger. We're using it in a particular context, in a particular way, where it makes an actual difference, where it actually adds value.
And actually, just on that, we've got quite a few questions around how do you see blockchain and AI being used in digital banking? So could you give a couple of examples related to that?
Yeah, I mean, look, I'm a big fan of AI first and foremost, right? So for me, the way that digital banks structure their data, the way that they access the data, the way that they analyze their data is something that tends to be a differentiator compared to legacy banks. Legacy banks often have fragmented data systems. It's hard to access it. It's not always consistently understood. It's not always got a clear data dictionary. So you get mismatches, misunderstanding between data. Digital banks tend to do that really well. They tend to build those data structures and data sources really well from the beginning, which means that we can use advanced analytics. And I'm going to start with advanced analytics more than AI, but to do things like decisioning around credit, things like decisioning around customer journey, things around like recommending to a particular customer what the next best action might be for them to take. You know, maybe we can see that you have a bill that's due to be paid. We don't even need to wait for you to come to us to pay that. We can say to you, I see your phone bill's due today. Do you want us to pay that for you? And you just click a button that says yes. So we can really see how that drives efficiency. But if I go beyond that and start to think then more about machine learning type capabilities, it can tidy up a huge amount of overhead in our back office processes and systems. It can help us do those things a lot better. Things like if we have transactions that haven't posted properly, we can use things like machine learning to get better at matching those transactions. We can start to use it for managing human interactions. So I don't know if anybody's tried to use them yet, but you're seeing an increased number of almost synthetic agents. So it's not a chatbot, it sounds like a voice call that you're having, but it's actually a fully synthetic voice that's been created, and you can actually have really strong dialogues there. So we will see that come into customer service across the board, to our risk decisioning, our risk identification, our response to cyber threats. There's a huge amount of places where data and AI can go. Blockchain is slightly more complex, right? So I said before that we had launched a blockchain-based trade finance bank in the UAE. And the reason that blockchain was a really useful tool for the trade finance bank. Because if you think about the specific flow of a trade deal, it's got a lot of different players, it's happening in a lot of different markets, it's happening in a lot of different time zones. There are a lot of physical validations of trades that need to happen that don't happen on a kind of easy ledger basis. But if you start to have the blockchain validation of that, then actually it becomes really useful. So blockchain for me has to have a very specific use case. It's usually around slightly more complex transactions with multiple players involved in them, multiple markets involved in them, more than perhaps something like data, advanced analytics, AI, which will be part of our DNA in everything that we do.
Great, thank you, Sarah. We've got loads and loads of questions. I'm just going to run through a few more. There's been a few questions from people who want to start digital banks. So they want to start digital banks, asking questions around what sort of capital requirements are required for that. Who is the first person you'd hire into the bank? What are the key challenges you face in creating a digital bank? Could you just touch on sort of maybe a bit of D360's journey, but generally, and your experience as well, of what are the key things to look out for someone who wants to start a digital bank?
Yeah, I mean, look, I can do a whole session on that, right? To give you a quick answer is tricky. The first thing that I would say is that I left, when I joined Tandem, I'm going to talk very quickly about Tandem. When I left Tandem, I left Deloitte to join Tandem, which was a digital bank that we launched in the UK. I was at Tandem for about 18 months in total before I moved to the Middle East. And before that, I'd spent about 14 years working in the industry. The 18 months that I worked for Tandem, I learned 10 times as much as I had in the previous time in my career. And the reason for that really was that in a startup bank, you have so many moving parts, you have so many challenges every day that you can't help but be part of many of them. You can't really try and stick in your box. You have to look to everything that's happening. You have to be part of multiple conversations. You know, we in the UK at the time, we had to do things like take out the bin bags. We were at that level where we were kind of really scraping funds, and you had to do a bit of everything, be the cleaner, be the tea maker, be the person writing regulatory applications, select the systems, set up the contracts for the systems you're selecting. So anybody thinking about a career in digital banking, be it starting their own or looking for opportunities within the digital banks, the fintechs that are coming in the kingdom, if you are able to deal with the variety that comes with that, you're able to be prepared to deal with some of the ambiguity that comes with that, some of the stress that comes with that, I'd say don't think twice about doing it, because it really is something that changes the way that you think about your career. It changes the way that you think about financial services and about banking. So that's the first thing I'd say. In terms of the challenges, capital requirements vary by market, right? So you'd have to look at specific regulators, and it depends on the nature of the bank that you're going to launch. It depends on the projections of customers you're going to have, the makeup of products that you're going to bring. So you kind of have to look to work that out and do that over time. It's not cheap to do it with a full banking license. And as we said before, that's why some banks have gone the route of starting with a payments route first and then transitioning to banking. But really the biggest challenges are having a clear view of why you're differentiated as a bank. You were just asking the question around how are we different to a legacy bank. If you're not clear on that, if you can't tell that story, if you can't bring your customers with you on that journey, you're not going to get the acquisition and numbers that you need. You're not going to have the profitability that you need to be successful. So that's one thing to think about. Have you got a really clear vision, a really clear understanding of why you're going to market and what you're doing? The second is hiring the right talent. We kind of said earlier on that we're increasing the capability of fintech knowledge, awareness, capability in the kingdom. So there absolutely is access to great talent here. We still need to find talent to help that, and we're seeing a lot of the digital banks are augmenting local resource with overseas resource, but finding the right talent is really important. Making that talent gel as a team is really important. So when you're a digital bank, when you're a fintech, it can be stressful. There are difficult decisions. There isn't really a day that's a standard day. So you need to have a group of people who work together to solve problems, to figure it out as they go along, to be happy to do that. So building a team is a really big challenge. And honestly, in terms of the first hires, I don't think it's about the specific role or capability that you're bringing in. I actually think it's about bringing in people who share your value sets and people who share your vision. And then between that group of people, you will find a way to make that vision come to reality. You'll be able to augment the team with the skills that you don't have. You'll be able to learn some things that you didn't know you needed to know, and find out ways of doing that.
Thank you, Sarah. Great answers, and hopefully we'll see some digital banks being launched from this session. I won't keep you longer. Thank you very much for answering all the questions. I guess my final question is, I'm sitting here, I'm saying, just learning about digital banking for the first time. I'm super excited. Where can I go to learn more? What can I do to sort of upskill myself in what's happening in digital banking and what's happening in Saudi?
Yeah, we can share some links with people after the session that give people some information. I would say that all of the large consultancies publish information on a regular basis about what digital banking is, what technology trends are happening that might impact digital banking, what adoption is on digital banking. So, use your Google search engine and ask the questions, and you'll find reports from reputable sources. And the one thing I'd say there is be careful that you're looking at a source that's knowledgeable. So the big consultancies, the big media agencies, you can look to places like Medium for quite interesting content on digital banking. And you can look on LinkedIn, right? So if you know some of the digital banks, there are some people on LinkedIn, some profiles that produce great content and share great articles that are well thought through in this space. So you can look to your network of peers, you can look at the people who are doing the job and the content that they're creating and publishing. And as I say, that the big consultancies really are a great source of introductory information.
Fantastic. Sarah, thank you very much for your time. It's been a pleasure having you with us and giving an overview to everyone. We've still got 2,500, 3,000 people on the session. So clearly you've had a massive impact on everyone.
Thank you all for joining. And I know I can't see you all, but it's been